My name is Chris Laughton, and I'm Director of Knowledge Exchange here at Farm Credit East, a position I've held since 2011. Just quickly before we begin the webinar, a couple of things. One of the challenges in doing a webinar on a topic like this is that people come in at all different levels of experience, knowledge, and background. So there's always a risk of being too basic or too advanced or moving too slow or too quickly. So I'm trying to sort of shoot for the middle. I will be covering things fairly quickly, but keep in mind that this webinar is being recorded for future playback, or if you wanted to, if you didn't get something and wanted to kind of catch it again. And also the slides are in the handouts part of the GoToWebinar control panel. The slides are there as a PDF, and there are two Excel files, which I'll get to about midway through the presentation. I'll talk about those. So with no further ado, I will go to our agenda. I'm going to give a little bit of an introduction about Farm Credit East and who we are and what we do. I'm going to talk about the importance of record keeping in agriculture. I'm going to introduce financial statements, how to read them, why they're important, what they cover, and then we'll go into cash flow budgeting. And finally, we'll have a talk about financing and access to credit, and then some time for Q&A at the end, hopefully. We are committed to ending at noon, so I hope that we'll have about 15 minutes or so at the end for questions and answers. So just briefly about Farm Credit East, we are part of the National Farm Credit System, which covers all U.S. states and territories. We are a farmer-owned cooperative. We serve roughly 14,000 customers across 7 states in the Northeast. We have more than $7 billion invested in Northeast farming, fishing, and forest products, and a 100+ year commitment to agriculture. And not only are we committed to agriculture, but we're committed to programs for young, beginning, small, and veteran farmers as well. That's a core part of our mission, is to serve all of agriculture from big to small, new to experienced, and all different sectors. So our services, we have 20 branch offices throughout the region, and you can kind of see the map of our territory there in the upper left corner. We have 470 dedicated employees, and then we have a whole suite of services, which you can see on the gears on the slide here. So I won't spend a lot of time going into those, but suffice to say that we have a lot of services that we offer to farms, and they're not just for big farms, they're for farms of all sizes again. So one of the very first things when we talk about business basics is defining what success means for you. One of the great things about owning your own business or starting your own business is that you can run the business the way you want, and you get to determine what the goals of that business are. And many people that go into farming, fishing, or forestry have a number of non-financial goals that are important to them. They may be interested in a certain lifestyle. They may want to produce their products in a certain way. They may have issues of sustainability or ecological management that are important to them. There could be any number of non-financial goals. And so I don't want to suggest, I'm going to talk a lot about profit and profitability in this webinar, and I don't want to suggest that profits have to be the only goal of your enterprise or even the primary goal. But ultimately, profitability, as I say here, is a prerequisite to achieving those other non-financial goals. If you're not at least breaking even, your business is not going to be sustainable over the long term. So it's important to be profitable, and that will enable you to achieve those other non-financial goals that may be important to you as you run your enterprise. So again, I'm not here to say that you need to absolutely maximize the return on your investment, if you will, but you need to at least be achieving some measure of profitability if you want your business to be sustainable over time. So in business, there are 3 basic areas of business skills. And this is true really for any business, but particularly for agriculture. There are production skills, marketing skills, and financial skills. And really few people are great at all 3 of those areas. If you're lucky, you may have 2 of those areas where you're exceptionally skilled. It's important to partner or hire the skills that you don't have and recognize where your limitations or your blind spots may be, and be willing to engage with other people on a either an advisory or a paid basis, and bring in people that have some of that expertise that you may be lacking. So there's not a lot of people that get into agriculture because they love paperwork. Most people get into agriculture because they love farming, they love the lifestyle. Again, they have maybe these non-financial goals that they want to achieve. But ultimately, record keeping is an essential part of any farm business. So one of the things is, when we think about things that we need to run a successful farming operation, we need, of course, things like labor, plants, crops, or animals, inputs and supplies. Your business may involve land and equipment. If you're fishing, of course, you need a boat. But ultimately, good records are as essential as any of those other inputs in order to run your business successfully. And that's where we see beginning farmers tend to fall down more than in any other area, is in the record keeping and the financial management of things. So record keeping is required for taxes, of course, as we know, but it can do so much more. A mistake that a lot of people that are new to business make is that they don't think about record keeping until January 1st hits, and they have to start getting records together for their tax preparer. That's, of course, the minimum that you have to do. But if that's all you're doing, you're really missing out on a big management opportunity, because the ultimate goal is to be able to manage your business from records. You need to keep them up to date and accurate. And it's important to create a budget with expectations and measurable results, and then be able to compare your actual performance to your budget, and then act as necessary to address shortfalls or any discrepancy that happens. So farm managers, when you signed up to manage a farm business, or to start or run a small farm business, you also perhaps inadvertently signed up to be the CFO. The CFO, or Chief Financial Officer, is something that's necessary for every enterprise. And in a small business, that's just another hat that you have to wear. And that's the person that's responsible for financial analysis and planning, managing your assets, arranging financing for the business, and ultimately making sure that your business remains profitable. So don't forget that hat when you're running your farm. And it's key to profitability. We talked about production management, and that's usually where most beginning farmers focus on things like producing a quality product in quantity, managing your costs, and that's that top circle there. And that's, of course, perhaps the most important one, because if you're not producing a quality product, it's just a non-starter. You're not going to even get off the ground. But pretty quickly, the other two circles come into play. You're going to need to look at marketing management, think about who is going to buy your product. If you're in a commodity business, say you're in dairy, your milk may go to a co-op, and that may be the end of your marketing decision making. But it's still something you need to think about, even in a commodity business. And if you're in a direct consumer or retail business, it's even more essential. You need to set your current prices, think about your sales volume, think about how you're going to reach out and get customers, all those sorts of things. And then financial management comes into play. And that's where you have to do things like budgets, accounting, think about paying your bills, managing your finances, those kind of things. Ultimately, to be successful, businesses want to be in the nexus of where those three circles interact. So one of the things that we talk about at Farm Credit and in many business management areas is what we call the 5-line income statement. This is a really basic income statement, and you should be able to express the finances of your business in this simple way if you're going to seek financing or just evaluate your business in any real way. Obviously, for management purposes, you'd have a much more detailed income statement, but this is kind of a start. So, and the numbers here are from an actual farm, so they're not, obviously every farm is different, but these are not atypical. So here we have gross sales of $134,000, and obviously by definition that's 100% of sales. The cost of goods sold, or variable costs, or what it costs to actually make their products, comes to $80,000 in this example, or 60% of their sales. That leaves 40% for gross margin. And gross margin is basically what you have after you've sold your product less the cost it took you to make that product. Your gross margin is what you have to pay your overhead and your profits. So in this example, the overhead cost came to $40,000, roughly 30% of total sales, and that left a net profit of roughly $14,000, or roughly 10% of sales. And there's a few reasons why I brought this example up. One is to show, as an example of how quickly the money goes. This farm is doing $134,000, so not super small. They actually have some real revenue there. They're doing, more than $10,000 a month. Or if you look at growing season, they're probably doing maybe $20,000 a month during the growing season, and then less off season. So they have some real sales, but at the end of the day, they really only have 10% of it left as their profit. And of course, that's what you have left to pay off debt. Your principal payments will come out of profits. That's what you have to reinvest in the business if you need to buy some new equipment or replace things or expand your business. In this example, the owner draw, we included an overhead as a fixed cost. I like to do that rather than have it come out of net profit, because really your salary or your compensation for your time should be a fixed cost. Many farms, we go out, we sell a product, we pay the bills, we pay the cost of goods sold, pay our overhead, and then hope and pray that we have some money left over at the end of the day for ourselves. I think it's more appropriate to put that in overhead costs and treat it really as a fixed cost, something that has to be met in your accounting. So that's just an example of the 5-line income statement, and we'll come back to that in a minute. So cost of goods sold, why is that important? Another name for cost of goods sold is variable costs. These are the direct costs of producing your product. So it's any expense that helps produce one more unit of output. And the reason that they're called variable costs is because they vary with production. So if we take for an example a greenhouse, let's say you're growing hanging baskets, your cost of goods sold would comprise things like production labor, seed, fertilizer, well, you wouldn't have feed for a hanging basket, but the fuel to heat the greenhouse, the supplies, any of those things where if you're producing more, you got to spend more. So those are called variable costs, and they're included in that second line of the 5-line income statement. Fixed costs are your overhead expenses. Those are the indirect costs of doing business, and we separate them because they behave differently. These are costs that generally remain the same regardless of variations in your productivity. Or if they change, they tend to change in steps as you might expand. So these are things that you need just to open the door and turn the lights on. Whether you produce 1 widget or 10 widgets, they're going to be the same. So these are things like office staff and supplies, professional fees, property taxes, insurance, depreciation, anything that's not directly related to your production, anything that's not going to go down if you don't sell 10% of your output, for example. All those fixed costs are important to keep track of in that bucket. And when we talk about overhead, one of the things that people sometimes are challenged with is having to determine what overhead really is. So one of the shortcuts that we use is called the dirty 5. If you buy, say, a piece of equipment, let's say you put up a building, to use one example. So depreciation would be the cost of that item over its useful life. So let's say you have a greenhouse that's going to last 20 years. For a useful life before it's going to need major renovation. Depreciation would be the cost of building it divided by 20. So that would be your depreciation cost. Interest would be the interest you're going to pay on financing it, assuming you didn't pay it with cash. Repairs are those anticipated annual maintenance costs of the item or the equipment. Taxes could be any impact you may have on property taxes, excise taxes, on something like a tractor or something that could be insignificant, but on a building they could be more significant. And then insurance is the cost, if any, of insuring that item. So, and they typically go in that order in terms of the magnitude of the cost as well. So the dirty 5, add those together and you get the overhead for a particular investment. So returning to that 5-line income statement, we have our gross sales, we have our cost of goods sold, which we're subtracting from that. That's the cost of producing the products that we're selling. That leaves our gross margin. We have $54,000 to play with to recover against our overhead costs and hopefully have some net margin left over. Then we have our overhead, our fixed costs, and then net margin. So what if your gross margin is low? What if this second line here the third line here is not 40% of sales, but let's say it's 20% of sales. That would be a really low gross margin. So what if it's low? Well, one reason, of course, could be the pricing is too low. Maybe you're selling your stuff too cheap. One thing that we see in a lot of direct-to-consumer agriculture is that a lot of farmers are afraid to charge. And, we say don't sell yourself short. You want to get what the market will bear for your product. Of course, we see you can go too far and be unrealistic in your price expectations. But if you're selling out quickly of everything you produce, maybe you want to look at your pricing and see if you can get a little bit more. If you can raise your price, let's say you sell 10,000 of whatever that you produce a year, 10,000 widgets. If you could get $1 more for every one of those widgets, that's 10,000 extra dollars. And that goes straight to the bottom line because your cost of goods sold doesn't change, your fixed costs don't change. So that's going to make a huge impact on your bottom line. So another reason for low gross margin is that cost of goods sold could be too high. Perhaps you're not operating efficiently. Perhaps your input cost to your product is too high for some reason. And then the third one, and this is a big one, is what we call shrink. Shrink may be too high. And what shrink is it's any product grown or made or purchased. If you, for example, let's say you have a farm stand and you're buying in some product that's not able to be sold due to lack of demand, not enough customers, poor quality, spoilage, theft, or any other reason. A great example of that is, let's say you have a Christmas tree lot. You might be buying in Christmas trees. Let's say you buy them for $10, you sell them for 30. Great gross margin. You're getting, 2/3 gross margin. So that's not an issue. Let's say your fixed costs are low. But if on December 25, you have half your trees left over, you did it all for nothing at best, and maybe probably even lost money. So that's why shrink is a really important thing to manage, especially with a direct-to-consumer business where you don't have a buyer that's willing to take an unlimited quantity of your product, where you have to earn every sale. You want to make sure that you're aligning your production with what you can realistically sell. Fixed costs or overhead, again, they behave differently. These are costs that don't change with each unit of production. If these fixed costs are too high, there's a few possible reasons for that. One is you could just be too small scale to be economical. If you're producing a product in your very, very small scale, but you still have all those costs of your owner time, you've got to pay a certain amount in property tax, perhaps you have to pay a certain amount in utilities, whatever else. Depreciation isn't going to change. If you're not producing enough product, then you may struggle with high fixed costs. You may not have grown into full capacity of your facilities. You may have overbuilt. And one thing to note is that fixed costs are less manageable after they're implemented. Once you build that building, you're pretty much stuck with it. So it's important to think about, if you're going to make a long-term investment like that, you want to think about, potential for growth. Are you going to need to expand soon after? Is it something you can grow into? But you also need to make sure that you're able to cover those fixed costs as soon as they're implemented, because once you've built that building, you can't really sell it or downsize it. So now we're going to get into accounting methods. Accounting methods can yield different results, and I'm not going to go into detail here on the differences between them. Just suffice to say that there can be differences. Most small farms operate on cash accounting, where they record expenses and income when the money is paid out or received. And so they're counting dollars in, dollars out. Accrual accounting is a little bit more complicated because you track your income and expenses when they're earned and when the expenses are incurred, respectively, regardless of when money changes hands. This becomes important if you're running a business that does a lot of business on credit. If you're holding house accounts, you're selling wholesale and your buyers may not pay you for a month or more. And if you're buying inputs on credit where you have delayed payments, that's where your accrual accounting becomes more important, because you really want to track your income and expenses properly, not just when you've received or made payment for things. Either method is really acceptable to most lenders, but it's important to know which one you're using and not mix them up, and just know that they can be different. So here's an example of how cash and accrual accounting for the same business can yield different results. So here's a farm, their income statement for 1 month, same farm in both cases, and they have, cash sales of their produce, $400. On the accruals side, we sold $200 to a grocery store, and they're not going to pay us right away, so we record $200 in sales on account. That gives us $600 in total accrual income. On the cash side on the left, we don't record those sales because they haven't paid us yet, but we are recording $50 we took in on sales we may have made in a previous period. So our cash income is $450. Again, things like paychecks may be different. We cut $300 in paychecks, but we actually accrued $400 because we haven't paid all our employees yet for their wages. Gas and supplies, we paid cash, so that's the same. But then we have this thing called depreciation. Depreciation is what's known as a non-cash expense. So some businesses tend to ignore it almost, but it's important to keep track of it because it's the rate at which your fixed equipment, you know, your tractors, your vehicles, your buildings, perhaps your equipment, it's the rate at which they're wearing out. And if you are not earning enough profit to cover your depreciation, you're doing what we call living off depreciation, which means that when that equipment starts to wear out, starts to need replacement, you're going to be in trouble. So it's important to account for it. So in this case, we can just see that this business that earns $60 in cash actually had an accrual loss of $150. So again, I'm not going to get into real detail on all the differences between cash and accrual, but just suffice to say that they can be different, and just kind of be aware of that. So going into financial statements, there are three main financial statements. The first one is the balance sheet. The balance sheet is a snapshot in time of a business's, or it could be for a person's, financial health. The income statement tracks a business's income and expenses over a period of time, usually a year or a month. And then the cash flow statement, also known as a budget, shows actual cash going in and going out, particularly as your business grows more complex. If your business is very simple and you're doing most of your transactions in cash, or cash equivalent, checks or credit cards, whatever else, then your income statement and your cash flow are going to be pretty similar. But as your business grows more complex, those are going to start to diverge. And so it's important to do both an income statement and a cash flow statement, because the income statement shows really whether you've earned or lost money, but your cash flow statement is going to affect whether you can pay your bills or not. So a rearward-looking cash statement, it would be called the cash flow statement. That's when you look at a past year. When it's forward-looking, when you're looking at the future year, you call it a budget. Either way, it's basically the same process. It's just one is a prediction and one is actual. And we'll go over all three of these. So the balance sheet, what's on the balance sheet? So the first section is your assets. That's what you own. And at this stage, we don't worry about whether there's a loan against that asset. We just record all assets that are owned. So let's say you have a house. Your house is worth $200,000. So that's a $200,000 asset that goes on that side of the balance sheet. Other things that go in here are things like cash, money that customers owe you, prepaid expenses, businesses, anything like that. So the next thing are your liabilities. These could be loans, accounts payable that you owe to other businesses, capital leases, accrued expenses, anything like that. So let's say you have that $200,000 house. You may have a $100,000 mortgage. So you record $200,000 in assets and $100,000 in liabilities. The difference between the two is your net worth. So in this case where you had a $200,000 house, a $100,000 mortgage, your net worth is $100,000. The difference between that asset and what you owe on it. Obviously, from a business or even most people, it's much more complicated than that. But it's important to note, to be able to explicitly detail what you own, what you owe to others, and what your net worth is, especially if you're going for credit. So here's a quick example. In this case, this farm has $12,000 in their checking account. They have some supply inventory, some equipment, they own a truck. So they have $27,000 in assets. Then on the liability side of the column, they have credit card debt, they have a loan, so they have $5,500 in liabilities. That leaves $21,540 as their net worth. And if you add up liabilities and net worth, it comes to $27,040, which is the same as what their assets are. And that's one of the reasons why it's called a balance sheet, because each side has to balance. Your assets must equal your liabilities and net worth. If they don't, then you've made a mistake somewhere. So moving on to the income statement. Oh, and just the balance sheet is as of a specific date. On a complex business, the balance sheet will change literally every day. So you pick a specific date, usually it's end of the month or end of the year, and then the balance sheet is a snapshot of what your financial position is. The income statement, by contrast, is a summary of income and expense flows over time. So it could be for a month, it could be for a year. But typically they'll say the income statement for the year ending, whatever, year ending 2019, for example. So your income is your revenue and sales. Your expenses are everything that you took to produce those products. And again, we typically break those into variable and fixed expenses, or cost of goods sold and overhead. And then the difference, of course, is your net income. So here's an example of a balance sheet, for an income statement for the year ending 12/31. So in this case, this farm had $61,000 in CSA shares. They had a little bit more than that in farmers market sales. And then they had a small amount of wholesale sales, and that came to $134,000. Then their expenses, you can see they had cost of goods sold were most of their expenses. They had a relatively small amount of overhead. They took an owner draw, and then their total expenses, and that left a total income of roughly $14,000. If it was a loss, you'd often see that in parentheses. So moving on to the last part, and perhaps the most important part, cash flow budgeting. So one of the many challenges in running an agricultural business is that your cash flow is typically not consistent from one month to the next as the year goes around. Most farm businesses have lean cash flow in the winter and then stronger cash flow in the summer and perhaps fall. So, but your expenses may not align with your cash income very well. So that's one reason why it's very important to do a cash flow budget. Again, if this was in retrospect, this would be known as your cash flow statement, and you'd record your actual income and cost of goods and all that. But in this case, we're looking forward, and we're going to budget for our future. So let's say we're looking at 2020. So again, in this example, January, we're going to look at what is our income in January, if any. What is our cost of goods sold? What variable expenses do we have? If you're, say, a vegetable farm, you might have some CSA income perhaps, and you're going to have zero for cost of goods sold at the moment. So your gross margin might be 100%. You might have some overhead. You're going to have perhaps some office expenses. Maybe you have some professional services, whatever else. That's going to lead to your net cash profit. And so at the bottom in these orange lines, you're going to look at what your starting cash is, so what your bank balance is at the beginning of the month. Your change in cash is equal to that net cash profit in the line up above. And then that starting cash minus the change in cash, or plus if you made cash profit, would result in your ending cash. And then as you can see from the arrow, the ending cash from one month becomes the start of the next. And so you just go through for 12 months. So it's important to look at, budgeting your income streams for each month, your variable costs, and your overhead expenses for each month. And then compute your starting and ending cash for each month. And if your ending cash goes negative in any one month, what that means is that you may have a problem paying your bills for that month, and that you're going to need to get some financing, either a line of credit, or you're going to need to take out a longer term loan, or put some of your own money into it or whatever else. But you'll be able to foresee that you'll have a cash crunch in a particular month. Oftentimes the hardest one for many farms is late spring, because you'll often have expenses that start to come through, but your revenue hasn't happened yet. So if you're, again, that vegetable farm, April and May may be very expensive months for you because you're planting everything, but you don't yet have anything to sell. So it's important to budget for things to make sure you don't run out of cash. So I'm going to kind of blow up this this spreadsheet to show you what it looks like on a little bit bigger scale. So here's the cash flow analysis for a whole year. And I'm not expecting that you'll be able to read all of this in detail, but we have 12 months and then an annual column. We have our total income, cost of goods sold. We're figuring out our gross margin percentage, our total fixed cost, net margin, that 5-line income statement. And then at the bottom there, we have our monthly cash flow, change in cash, and then ending cash. In this case, the ending cash is positive in all cases, so we're pretty good for our cash balance, even though some months are negative. And then, of course, if you go into detail and blow this all up, you can itemize your cost of goods sold, your overhead, all that other stuff. This is a process that you should put some time into, and it will take time, but it's really important to do this because it's a way to plan out your cash needs for the year. And then it's important also to look at not only your budget, but your actual as each month ticks off. Did you meet your expectations? Did you get the revenue you thought you were going to get? Did you spend more than you thought? Did you perhaps earn more than you thought, which could be good. So there's I'll give you a web link where you can download this spreadsheet, and it's also included as an attachment to this webinar as a handout on the GoToWebinar panel. So you can get it as a live web sheet. It's a live Excel spreadsheet. It's pre-populated with just some example data, but you can certainly edit that and make it your own. So there's one for a sample CSA farm, and there's one for a sample grass-fed beef operation, just as examples. Obviously, your situation would be different, but it's a chance to take a kind of look at a spreadsheet that's been done and work it out and make it your own. But just going into a little more detail, we can see the top section is farm income, and here it's detailed. There's no other income other than the CSA for these months, but this just shows a way to track where the income is coming from. Then they look at cost of goods sold itemized by category. You'll notice that there's quite a few lines for labor. Labor for almost every farm, unless you're extremely small, is going to be by far your biggest expense. And managing labor and keeping on top of labor costs is going to be probably the most critical part of managing your farm. Then you have some inputs there, and then again your gross margin. So going down to the bottom half of the sheet for these same months, we have overhead fixed expenses. You can see we have those itemized as they incur in different months. We have the owner draw. Then we have we have our net margin. And then importantly, we have other sources or other uses of cash. And that's important because these are things that are not income items per se, but they're going to affect your cash position. So in this case, in January, we had equipment purchases of $5,000. So that's recorded as a negative $5,000 on our cash flow budget sheet. Of course, that equipment is going to last us for a while. So it's not all an expense for January. We're going to stretch that out and depreciate it over a long period of time. But in terms of cash, that's $5,000 out of the checking account that we have to keep track of. We're going to sell an older piece of equipment against that. So we have a $500 benefit or income in equipment sales. And then we took out a loan for $4,500. So we financed that equipment purchase. So the net cash result actually was zero in this case. But it's important to pencil it out because you could see if that equipment was more expensive than what we financed, or if we borrowed more than there's any number of scenarios where that could be a non-zero cash impact. So then we take our monthly cash flow, and then you can see we had $6,540 to the positive, mostly because of CSA sales. We started off the month with $5,000, so that brings our ending checking balance to $11,540. That carries over into February's beginning balance, and then you can see some months are positive, some months are negative. But that's just an example of how you would fill out the cash flow budget. So here's a link to download the live spreadsheet. So now I'm going to get into financing your business and access to credit. So one of the things that people often struggle with when they're starting a business is that there are different kinds of capital and different sources of financing. When you're starting a business, what you really need is equity financing. That's investment. That's your startup or your venture capital. That's going to come from yourself, maybe relatives, maybe an angel investor, perhaps some kind of lender will take a chance on you. At this point where you're just a startup, you have a high risk of failure or a high risk of loss of that capital. An equity investment may require you to give up some ownership. You may have to take on a partner or give them some shares in your enterprise. That's often what you have to do when you're starting up a brand new business. Debt financing is a little bit different. Debt is loans, and loans are usually given to finance ongoing operations or expansion. They don't dilute ownership. The cost is limited to the interest you pay rather than a share of profits. They're often based on collateral, whether it's land or equipment. And this is really where commercial banks live. And sometimes people get frustrated with banks because they can't get financing for a startup business because they don't really understand that that's not what banks do. They don't really exist to finance startups. You're not likely to walk into a bank with a business plan and a dream and walk out with financing. Banks generally will finance against collateral for a purchase or an existing operation that's profitable or wants to expand, but they won't generally finance a pure startup operation because they want to see existing income. So that doesn't necessarily, that's not bad or good. It's just knowing what banks actually do is important if you're going to approach one for financing. So, of course, that's a big nut. That leaves a big nut to crack to come up with starting capital for a business. And partly as a consequence of that, Farm Credit East a number of years ago established a program called Farm Start. What Farm Start does is it's designed to kind of bridge the gap for beginning farmers to get some operating funds for a new and beginning agricultural enterprise. So it invests up to $75,000 in capital for new and beginning agricultural enterprises that is either minimally secured or unsecured debt, or we call it investment, but people have up to 5 years to repay it or roll it into conventional financing. We've made more than 300 investments and over $13 million in over 14 years. That's a joint venture of Farm Credit East, CoBank, and Yankee Farm Credit. And the program is available throughout New England, New York, and New Jersey. So that's just a little, commercial, if you will, but want to show that as an option. There are other programs similar to that also provide startup capital. The USDA Farm Service Agency has one, and there are some other angel investors too that have perhaps similar programs, which I'll get into in a minute. So yeah, there's a lot of options to finance a business. First, of course, is ourselves, the Farm Credit System, Farm Credit East, and our partners like Yankee Farm Credit. Then there's the USDA Farm Service Agency is another option for a lot of beginning or fledgling enterprises. The seller can be an important financer for a lot of things. You may be wanting to buy a piece of property, and the seller may be willing to hold the paper on it and allow you to pay them over time. Commercial banks are important for financing. There are angel investors or nonprofits out there, and there's also things like community development corporations, economic development agencies, things called CDFIs. There's other sort of non-traditional financing options out there. So there's quite a few. And if you're going to be getting a farm enterprise, it would be in your interest to look at as many of those options as you can. So how do farm lenders determine whether someone gets financing? So most lenders use what we call the 5 C's of credit, and that's pretty universal. Most lenders use them. They each may weigh each of those 5 C's differently, but they generally look at all of them. So starting with the top here, character. Now, one's character, of course, encompasses a lot more than your credit score. But for the purposes of borrowing money, the credit score is a big part of that. Ideally, it would be 700 plus. It demonstrates your performance on past debt. It indicates your existing debt. It's important to know what is on your report and to be able to share and explain any problems that exist. And two websites where you can get access to your credit report are annualcreditreport.com and creditkarma.com. You can get there for free. There are a number of services that will give you your credit report or credit score and charge you for it, but those two will give it to you for free. So it's important if you're going to go in for to borrow money, almost any lender is going to pull your credit report, and it's important to know what's on there and be able to explain it. So if you had a dispute over a borrowed amount at some point, be able to explain, well, this is because of X, Y, and Z, and it was resolved, and whatever the case may be. Many lenders will be understanding if you can explain things, but if there's unexplained problems that show up, that's obviously not a good sign. Capacity. For a lot of lenders, including Farm Credit East, this is perhaps one of the most important ones, and this is how you're going to repay the loan. What are your earnings today, primarily, and what will they be after the investment? So if you're going to invest in something that's going to expand your business, what's your profit on day one and what's your profit after you build out? If you're relying on increased revenue from the investment to pay the loan back, that's obviously more risky than if you could pay it off at day one, on a monthly basis. So each lender is going to look at that a little differently. Here's where history is important. Lenders are going to want to see those financial statements that we talked about. They're going to want to see projections and budgets that show that you can cash flow the payments. And it's important to think about what happens if things don't go as planned. What if you have a greenhouse and it rains every weekend in May? Do you have a backup plan, a plan B? And particularly for a beginning farm, off-farm income can be very important here. Collateral. This is the lender's fallback position. What happens if everything goes to heck and you can't pay off that loan? This is how the lender is going to be made whole, hopefully, for them. Real estate is best, obviously, but things like livestock, machinery, and equipment and inventory can also be used as collateral. It's important to consider that a lender is going to look at what is it really worth at like an auction or a distressed sale. There's often two values for everything. There's the fair market value, which is what something would sell under normal circumstances. And then there's what's called the net recovery value. That's what does it get in a distressed sale. And those are often pretty different. Capital. So this is pretty simple. Do you have skin in the game? What's your net worth? How much do you own net of your debt? What's the balance sheet look like? If the lender is providing a majority of the financing for your business, that's not a position that most lenders are comfortable in. They want to see that you have a significant stake in your enterprise. Finally, conditions are basically the terms of the deal. So for real estate, those are often 10 to 30 years, machinery equipment 3 to 7, livestock 1 to 3, inventory less than 1. Really, the loan term should be shorter than the life of the asset financed. I was talking to a colleague here this morning. One of the things that I say is if you can't cash flow the payments for an equipment investment for 2/3 of the life of that equipment, you want to really think hard about whether that purchase makes sense. Because in the last third of that equipment's life, you're going to start to have repairs and maintenance costs that are going to increase. So if you have an old piece of equipment that you financed for an extended term, you maxed out its useful life, at the later years of that life of that equipment, you're going to have not only payments still, but you're going to have repairs as well. And that's going to make that a really expensive piece of equipment to own. And if you want to replace it, you're going to have to address that negative equity situation that you have where you still owe money on a piece of equipment that might not be worth very much. So how do lenders arrive at a decision? Well, there's multiple considerations and each lender weighs the criteria differently, but there's those C's that we talked about. So there's a few kind of caveats to lend or pitfalls. One is, as I said, don't finance beyond the useful life of an asset. In this case, this person has a car that's basically worthless and they still have to make payments. And this unfinished house shows cost overruns happen sometime. We call it borrowing your last dollar. If you max out all your lines of credit and you run over on a construction project, the lender is not usually under any obligation to extend further credit to you. So you may be caught with a half-finished project. It's always important to have some contingency available. Another one, and a big one that we see, is if a business is losing money and they come to borrow money because of a loss. That happens to a lot of businesses. It's not necessarily a terrible thing. Sometimes businesses need to get through a rocky period or a bad year, but it's important to think about what's going to change so you're not going to do it again next year. Because one thing you definitely don't want to do is repeatedly borrow to cover operational losses. That's what we call sliding down the razor blade of life. You're just going to continue to borrow until there's no equity left, and then you're going to lose everything. So it's important to really think about, you need to make some fundamental changes to your business model so that you're not coming back to the well for more capital if you have another losing time period. Lack of commitment. When the going gets tough, the tough stick it out. Your lender is in it for keeps. It's important that you are too. And then basically some lender turnoffs, some of which we already discussed. But poor records are one, high existing debt, low credit scores, relying too much on collateral. You may have good collateral in real estate, but if you're not earning enough money to cash flow the payments, your lender is going to be really concerned about how you're going to pay back that loan. Low personal investment, unrealistic expectations, etc. So with that, I will thank everyone for their attendance, and we'll go to questions. Hopefully we have a couple, and we'll address those.
Thanks, Chris. Yes, we do have one question that came in, and that is, in terms of financing, is it possible to get debt financing for starting a farm business if you have other sources of income, like an off-farm job?
Yes, that's actually a great question, and that's a very good question. We call that a W-2 loan, and a lot of either beginning farms or part-time farms work where it's an enterprise that's not fully sufficient to replace the borrower's income, but it's something they're doing on the side, or they're just starting, and they're going to be rely on that outside income to pay, to be able to at least pay back or partially pay back those loan payments. And yes, the answer to that is yes, it is possible to get debt financing in those circumstances. One thing I will talk about briefly is that we get a lot of questions about startup businesses. The reality is that it's a challenge to start up any business. Let's say you're trying to start up a car wash or a dry cleaner. That's hard, and agriculture is particularly hard because there's often high capital costs involved. You may need real estate, you may need equipment, you may need other things that are very expensive up front to start with. It is a real challenge to start a beginning enterprise because it's very high risk. Some of the things that are there that can help are, of course, there's the network of yourself and friends and family that many people rely on. But in addition to that, there are the off-farm income can be critically important. Having a part-time or full-time off-farm job and then doing your beginning enterprise on the side, at least as first, can be really important. Other things, like I mentioned, our Farm Start program can be really important to provide some operating capital, and that caps at $75,000. So it's not really enough. It's not designed to buy real estate, for example, but it can be combined with another source of financing to get someone started. And that $75,000 in minimally secured or unsecured debt is designed to provide operating capital. So let's say you bought some land, you may have taken out a mortgage secured by real estate, and that's great, but that gets you land. You still need to, till the soil, you still need to plant something. That's going to take labor, it's going to take equipment, seeds, whatever. And that's where Farm Start is designed to help out. So whether you're operating on rented land or you've secured it through some other source of financing, or if you're doing a service business, that Farm Start investment can really help you get started. And as I mentioned, it's not, obviously we want FarmStart is our program, so it's something that we think highly of, but it's not the only source out there. There are other options. There are Farm Service Agency has some beginning farmer programs. And there are other programs, like one that comes to mind is the Carrot Project, which covers, I believe, Mass and Connecticut. There are other sort of angel investors or early stage investors out there that are willing to take a chance on a beginning enterprise. So it takes a little bit more looking and sometimes some creativity, but that, as I said, that big nut to crack of the initial capital can certainly be overcome. It's a challenge. It's not easy to start a business, but it can certainly be done, and the track record of FarmStart speaks well to that.
Chris, there may be a couple farmers or operators that are listening that are in their first couple of years of their business, and they've kind of gone at it the way they know best, but haven't quite started the real business planning or financial planning piece of this. What would you say they need to focus on?
Yeah, if you have an existing business, say you've been in business a couple of years, you have some revenue, you have some production, but your results are not where you want them to be. You're not as profitable as you'd like. The first thing to do is to really look at your expenses closely, itemize your expenses, and then put them in buckets of whether they're variable or fixed costs. So let's say you're a small dairy farm and you're producing milk. You want to take all your variable costs, all those costs that go into the actual production, and take that against your milk price and make sure you're at least earning on a cash basis against your revenue. Then you want to take your overhead expenses and look at those kind of separately. And if your overhead is too much, if you're not covering all your overhead, then maybe you need to think about expanding your production, or you need to do something else or tweak your cost of goods sold. But you want to look at it in two ways. You want to first make sure you're getting a positive gross margin, that you're actually making money on what you're producing. And then you want to look at your overhead and see whether your overhead is being covered by your gross margin that you're making. If you're a direct-to-consumer business, you want to think a lot about your marketing and your promotion. It's a real challenge as a small business to sell all of what you produce, and if you can't, you're going to have that dreaded shrink that I talked about. So you need to really think about your promotion, who will buy the product. Think about, for example, a lot of direct-to-consumer businesses. Let's say you're selling vegetables. The challenge with vegetables, of course, is that they're ready when they're ready, not when you're ready. So you may get hundreds of pounds of tomatoes one week, and your farmer's market just is not going to absorb those. It may make sense for you to find a wholesale outlet for some of those, and even if you don't make a lot on those, you're recovering some cash that can go towards that overhead to get rid of that extra volume, because the one thing you don't want to do is throw stuff out.
Reflecting back on your greenhouse industry experience, what were your biggest challenges as in running that business? Or
yeah, it's funny. I look at my nursery and greenhouse days fondly, and I miss them. And I realized that we had a lot of challenges in our business. And like a lot of small farm businesses, we were up and down. We'd have some good years, we'd have some tough years. In the end, we were a relatively high fixed cost business. So when our sales volume dipped, if we had a tough year, either economically or weather-wise, we struggled to cover all our fixed costs. We had we were very labor heavy. That was a challenge that we faced. Labor was probably the biggest challenge that we faced. We had we were fairly good size, depending on what you compare us to, I suppose. We grossed about $4 million a year and had about 20 employees. And that payroll was significant, at least for us. And that was a real challenge. And marketing was a constant challenge. Particularly in the later years of the business, a lot of chain stores came in and, challenged our market position. So there was a number of challenges that we faced. And, ultimately the business is still operating. It got sold to a new owner, but that's a positive. Yeah, it never gets easy, I guess, even when you become more established.
That's right. Thanks, Chris. One question on if these similar resources are available, say, outside of our region in the Northeast?
Yeah. Well, as I mentioned, the USDA Farm Service Agency programs are, of course, national. The Farm Credit System is national, and it's made up of about, I believe it's the number now is like 65 associations.
69.
69, okay, I'm corrected here. 69 associations, most of which cover one state or part of one state. Depends on, some are very small, some are large, multi-state and larger, but in any case, there's coverage throughout the whole country. And they all have programs for young and beginning farmers. The programs vary by association, so it's gonna vary by who is covering your territory. If you go to farmcredit.com, farmcrediteast.com is our website, but farmcredit.com is our national website. And put in your location, they'll give you the Farm Credit Association that serves your area. And I would encourage you to inquire with them about their young and beginning farm programs. And they, I'm sure, would be very happy to talk to you. And that's another thing that people mistakenly make, perhaps, is if they get kind of nervous or intimidated. And it's free to have a conversation. And I think you'll find that the people will be very receptive to talking to you, even if you're at the early stages of planning your business. So I'd encourage you to look into it.
Chris, in the minute we have left, can you talk about a couple of the incentives that new beginning small veteran farmers receive here at Farm Credit East for maybe using our financial services or getting started in Farm Start?
Yeah. So Farm Start, as I mentioned, it's really a standalone separate program. In addition to Farm Start, if you get a Farm Credit East loan, which is through us for perhaps real estate or a line of credit or what have you, we do have some incentives. One is we use Farm Service Agency guarantees quite a bit, and what that means is that the USDA is guaranteeing payment of that loan. So from our perspective, Farm Credit East, it lowers the risk and allows us to lend to some borrowers that may be too risky for us normally to lend to. The Farm Service Agency guarantee will mitigate that risk and allow us to make a lot of deals that wouldn't otherwise be possible. However, the catch is that comes with a fee. And as our what we call YBS programs, Young Beginning Small Farmer programs, and veteran programs, we will usually be willing to pay that FSA fee for the borrower, so it doesn't cost you any cash or get rolled into your loan. That's a big one that we use a lot. Other ones are discounts or incentives on financial services. We do everything from payroll to consulting to record keeping, and the YBS fee incentives can help get someone started on some of those services. And we also have a training program called Generation Next, which is geared towards people that are either getting into their own business or taking a greater responsibility position at a family business, perhaps. And we have a YBS fee incentive for that reduces the cost of the program by quite a bit. So those are just a few of the programs, and I'm sure I'm even missing a couple. So.
Well, thank you very much, Chris, and thank you to all of our attendees today. As you can see on your screen, for any of the materials that we presented today and a couple examples of the cash flow resources, those will be available at farmcrediteast.com/webinars. And make sure to refer to that website for any upcoming webinars or any past webinars for the materials there. So again, thanks for joining us, and enjoy your day.
Thanks a lot.